Welcome to Thoughts on the Market. I'm Graham Secker, head of Morgan Stanley's European and UK equity strategy team. Along with my colleagues, bringing you a variety of perspectives, I'll be talking about our latest thoughts on European equities, specifically why we remain positive on the outlook for European stocks and why the region looks well set to keep outperforming its global peers for the remainder of the year. It's Tuesday, August the 17th at 2 p.m. in London. Having moved sideways through much of June and July, European equities have re-accelerated this month, recently posting 10 consecutive days of positive returns for the first time since 2009. This rally has allowed European equities to break out to new all-time highs, which, while similar to what we are seeing in the US, is quite different to other global stock markets where performance has been more subdued. Post these recent moves, MSCI Europe has now outperformed global ex-US stocks by 10% over the last 6 months, which represents its best period of relative returns since 1998. For us, Europe's ability to keep pace with US stocks and outperform other global peers is particularly encouraging just here, given that it has not been accompanied by rising European bond yields or the outperformance of value stocks. Historically, such an environment is usually associated with Europe underperforming rather than outperforming. This unusual disconnect suggests that there is a more durable bid for European stocks beneath the surface, which should gain further traction if our bond strategists are right in their call for higher global bond yields over the coming months. In addition to this potential for higher yields, we see 3 further reasons to remain optimistic on European stocks for the remainder of the year. First, the fundamental backdrop remains strong. Europe is arguably seeing the best economic momentum of any region just here, with the data continuing to come in better than expected. From a corporate perspective, the second quarter reporting season was strong, with European companies posting their best ever pace of earnings and sales upgrades. Consensus now expects European profits to grow by more than 50% this year, boosted by strong pricing power, which is allowing companies to raise prices to offset any challenges from higher input costs. Second, last month saw the ECB strengthen its forward guidance substantially, which, in turn, prompted the market to push out the expected date of its first rate hike by 2 years to 2025. The prospect of continued policy support for another 4 years lifted longer-term inflation expectations to multi-year highs and pushed European real yields to a record low of -2%, further supporting the valuation case for European stocks, which continue to look cheap to us versus either US equities or European bonds. Lastly, after a sluggish start, Europe is now winning the vaccination race, which is underpinning the economy's reopening and potentially makes the region less vulnerable than peers to the Delta variant. This should boost investor optimism over the domestic outlook for 2022, at the same time as other regions are facing more uncertainty, whether this be about the trajectory of COVID cases generally, or more specific issues, such as the recent regulatory tightening in China or the potential for Fed QE tapering to weigh on emerging markets via a stronger dollar. To summarise, while Europe has outperformed global peers materially year to date, we see scope for this to continue over the coming months, thanks to a combination of healthy fundamentals, solid policy support, and the potential for investors to rotate into the region given increasing challenges elsewhere. Thanks for listening. If you enjoyed the show, please leave us a review on Apple Podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.